All right, welcome back, everyone. Here we are. We're episode 2 of the Avid Investor Podcast with me, your host, Josh Adamek. And today we're going to talk about the 3 types of investing in real estate, 3 different ways to invest in real estate. So you'll hear from, many different gurus, podcasts, whatever, that there's all these different spin-offs, the latest, greatest, way to, buy and sell, invest in real estate. But it boils down to there's 3 basic ways to do it. So there's wholesale, there's retail, and then there's the long-term play, the cash flow model. So the rental, the lease model. So to dive into each of those 3 aspects, it's I'm just gonna go into some of the basics here. So the way I got started, full time in real estate was wholesaling. At the beginning of my career, when I was working full time, I was buying some rentals. I'd buy a house, I'd fix it up, I'd rent it out. And I'd do that again and again and again. When I quit my full time job and I went in real estate, had to produce some income, some revenues. So I started wholesaling. And what that is, what wholesaling is basically controlling a property, getting equitable interest in a property, and then passing that contract, selling that contract, releasing, assigning, whatever you want to call it, to another investor for a fee. Now there's rules and regulations that you have to follow that go along with that. One, you got to have an equitable interest in the property. So you have to control the property. You have to, one, either own the property, or 2, have an equitable interest. And what that means is you have to have the property under agreement, whether that's an option agreement or a sales agreement. You have to control that property. So basically, what we do when we're wholesaling is we send out a bunch of marketing, a bunch of flyers. When I started, I was working, dead leads from another investor wholesaler. But in order to start wholesaling, obviously you have to have leads coming in. So there's time associated with that. There's cost associated with that. Really a lot of time. So you're basically, your job as the wholesaler is to find the deals and provide the deals to and the opportunities to buyers that want to work that strategy, that want to buy that property type, that are looking for the flips, or for for the long-term holds, or whatever the case may be. So basically, as a wholesaler, you're going to do some marketing, whatever that marketing is. You're going to send out postcards. You're going to do bandit signs. You're going to do the Google AdWords. You're going to do the driving for dollars, where you ride around, you look for properties for sale or vacant properties, talk to neighbors, all of which I've done. I've got deals from so many different sources, so many different ways of marketing. I can't tell you that one way is better than another, that you got to send out these mailers, or you got to do this door knocking, or, you got to do these Google AdWords, or you got to buy this, this marketing platform, or create a click funnel, or, whatever the case may be. I can't tell you one strategy works, because we've done them all. Some strategies work better in some markets and sometimes, and other strategies work better in different times. Right now, we're what I feel is towards the top of a market cycle, which means, there's a lot of people in the market. There's a lot of competition. And, as a wholesaler, you have to be the first one to that seller. You got to find that seller that needs to sell their property, that wants to sell their property, has to sell their property. When we're buying investment real estate, we're typically dealing with motivated sellers. So you got to get to those motivated sellers. What's the motivation? Motivation comes in many different forms, many different ways. Motivation could be, the property wasn't inherited. They don't want to deal with it. They live out of state. They're getting notices from the city or the borough that the property is not being maintained. Tax bills are coming due. Whatever the case may be, there's a motivation to sell that property. Maybe it's a pre-foreclosure, or another circumstance. They have to, move out of town, or moved out of town and no longer want to deal with that property. burned out landlords, especially, now with all this, all these restrictions we have with the eviction moratorium and all this crazy stuff that's going on. There's an opportunity there for, landlords that just don't want to deal with it anymore. So the key as a wholesaler is to get in front of those motivated sellers, and, negotiate a deal. And what you do when you're wholesaling, obviously, you have to know all aspects of the business. I mean, a lot of people have the common misconception that, wholesaling is an easy way to get started in the business. That's, all you got to do is find a property and then throw it out there and somebody will pay you 3, 5, 10, $20,000 more than you have it under agreement for. Well, that's not necessarily the case. Because what you have to do as a wholesaler is you need to provide value to your buyers. You got to be the guy that's finding the deals that make sense, not just locking up a property that's a crappy property in a crappy area that needs way too much work, and think that somebody's gonna pay you a whole lot more money than whatever price you have it under agreement for. That's totally wrong. What you need to do is you have to understand the market. You have to understand, street by street, property by property. You got to be able to gauge the repairs, the renovation costs. You have to know all the transactional costs involved with real estate. If you're selling a property that's going to be a flip, somebody's going to buy it, renovate it, and then resell it. You have to understand all the costs that are involved with that. So, oftentimes I see new wholesalers, people that are new to the game that don't understand all those transactional costs. They'll have a property that they're selling for 100 grand, needs 50,000 in work, and it's worth 200,000. If those numbers are accurate, they'll say, "Oh, there's a $50,000 profit here." Well, no, there's not. I mean, that can't be anything further from the truth. When you're rehabbing a property to sell it, there's transactional costs when you buy. There's holding costs. There's closing costs on the back end. If you're financing it, there's cost of the money. If you're not financing it, you should still account for cost of the money, because if you're using your own cash to do this renovation, I mean, you should be, compensated for, having your cash into that deal in addition to, the projected profit. So there's formulas, there's calculations that different people use. Maybe we'll get into that in more detail in another episode. But typically, when a rehabber's looking at a property, they want to be 65, 70% of the ARV less repairs. Simple math, the 35% accounts for some profit and some costs associated with the deal. So that's typical. That's like average. Obviously, if you can do better, you do better. But as when you're wholesaling, as a wholesaler, you want to make sure that you're providing value. So, I see a lot of people get into wholesaling and they think they got to build this giant buyers list where they got, 5,000 emails or whatever, and they're going to send this list, send it out. They're going to put it in the social media groups, the Facebook pages or whatever, and they're going to market their property and they're going to sell it. And that works. You can secure a property and you can market it. You can find a buyer. But I've seen a lot of very successful wholesalers that really only have a handful of buyers, and it's more so, like sort of like reverse wholesaling, if you want to call it. I'm not throwing any crazy names on it or anything like that. Any new, trendy terminology or anything like that. But, as I said, I know a number of wholesalers that only work with a handful of buyers, and they know what those buyers look for, and they go out and find those properties, and they know when those buyers are going to be ready for another project or ready for another property, they've got one lined up ready to go. So, as a wholesaler, you want to make sure that you're finding solid deals, that you're putting them out at fair prices, that you're not overpricing your stuff, that you're doing proper due diligence, because it's a long-term play. If you become that wholesaler that locks up good deals at good numbers and doesn't try to kill, your end buyer on a fee and leave them with a slim margin, they're going to keep coming back to you and buying more and more and more. So, that's the first way to invest in real estate is wholesaling. The second way is investing, retailing, flipping, rehabbing, whatever you want to call it. That's basically, when you buy a property, whether you find it off market, you buy it off the MLS, you buy it from a wholesaler, wherever, you're going to buy a distressed property. You're going to spend some time, money, energy, aggravation, rehabbing that property, doing a full renovation. Then you're going to put it back out on the market and sell it, to a back end retail buyer. So common terminology for that is flipping, flipping a house. I don't like that. I don't like that term. It's become very common over the last couple of years. But early on when I started, flipping houses was associated with flipping mortgages, which was an illegal transaction. And a lot of people got in a lot of trouble in back in 2007, 2008, 2009 for doing some unethical things and illegal transactions with flipping mortgages. So that kind of went away, and then the flipping houses became, I'm going to flip a house. Let's go flip a house. That's the terminology that's used now. So if you want to be a flipper, rehabber, retailer, whatever you want to call it, that's basically you buy a house, you fix it up, and then you sell it. With flipping a house, there's risk involved with that, depending on the price point, the back end price point, determines, your level of risk. So if you're in the lower price points, what I consider lower price points in the Pittsburgh market, median price points, if you're going to buy this house and you're going to sell it retail in the 100, 150, 200,000 price point, that's fine. That works. That's a good place to be in the Pittsburgh market. Benefit with that is if the house doesn't sell, if you go way over on your rehab, or you fix something wrong, or you pick the wrong area or something, you got multiple exit strategies. You can always, you can always refinance that property, or, leave your cash in it, or however you financed it. You can always, rent that property out and cover your cost. But when you get up into the higher price points, the 300s, 400s, 500s, upwards of $1 million, you got one choice with that house, and that's to sell it. So, and we do have a market right now in Pittsburgh for, those higher price points, that $500,000 to $1 million plus price points. The market's good right now. But again, like, nobody has a crystal ball. Nobody knows how long or the market is going to continue. We all know, many of us know market cycles. Historically, the market corrects every 12 to 14 years. Our last correction was in 2008. So do the math. We're due for a correction historically. We're due for a correction. We all thought COVID was going to be the correction. Little did we know that COVID was actually going to skyrocket, catapult the market, and it would continue to rise. So, many of us, many folks in the industry are very happy, where we're at in the market right now, for, as far as agents, realtors, agents, investors, developers, builders. The market's good right now. Our lenders are happy. Banks are still lending. So we're still in a very strong, very good market for, selling homes, retail, and flipping homes. The third strategy, which is my favorite, my go-to right now, is just the long-term plays. So what we do is, we buy, we operate under a private equity model. When I say we, it's my company, AVID Management Group. We operate under a private equity model where we basically, build portfolios of single family homes. Our focus is safety and security, regular houses, regular neighborhoods. And when I say that, it's just median price points in and around the Pittsburgh market. So we buy a lot of homes, your typical, 1950s brick ranch, 2-story, something that's not too old, 50s built house, has a real foundation, square footage isn't crazy. It's not the big old Victorian. So, the turn cost is, is digestible. The renovations, we can handle the renovations efficiently in the 50s houses. We're not dealing with knob and tube wiring. We're not dealing with, old sandstone foundations and, asbestos and all that stuff that's, that's common, very common in Pittsburgh, especially in the older housing stock. If you're listening from, out of the area, the Pittsburgh market, a lot of our housing stock was built in the early 1900s. So, I have a lot of friends that invest in, or very heavily invested in, Phoenix, Arizona, and those areas. Well, to them, an old home was built in the 80s. And like to us in Pittsburgh, it's like if we can get something in the 70s or 80s, it's like brand new. So it's, different markets, different strategies, but, for us, it's the long-term play. And when I say long-term play, like I said, we buy and build portfolios of single family homes. Our preferred exit strategy with those is we place residents on a lease option type program. A lot of people do straight rentals. We prefer the lease option model. Because we're providing, our residents with the opportunity to own a home at some point. They'll live there under a lease agreement. They'll have the opportunity, the option to purchase the home at a predetermined price within a set period of time. It's an option, not an obligation. That's our strategy. That's what we do. I know a lot of folks, a lot of other companies, a lot of other investors just do a straight rental model. We do some rentals, some single family homes. We don't do many multifamilies. We have a couple of duplexes in portfolio. In years past, I've had some small apartment buildings. Quickly found out, as our business grew and progressed, single family homes is where we want to be. Like I said, regular houses, regular neighborhoods. That's the long-term play. So to sum it up, the three ways to invest in real estate is wholesale, retail, and long-term plays. There's many different spin-offs from that. There's the Airbnbs. Was becoming a popular thing. I don't know if that's starting to go away now or not. Airbnbs was big for a while. Now there's like that. As far as the rentals, there's the BRRRR investing, which is I think it's buy, rehab, rent, and then refinance. So I think there's 3 R's on that. That's basically, what myself and a lot of people were doing many, many years ago. We would just buy, fix it up, and go to the bank and refinance it. So now there's a cool terminology for it. I'm sure there's some gurus out there selling courses that teach you how to do it, but it's basically you buy a house up, you fix it up, you go to the bank and you refinance it. As far as acquisitions, there's many different ways to finance investment properties under the rehab model, the retail with the flip model, or the long-term play. There's traditional bank financing. Of course, as long as banks are financing properties. Of course, there's the cash model, depending on how deep your pockets are. What we do at Adamek Management Group is we operate under a private equity model. So what we do is we work one-on-one with private and institutional investors to create and manage portfolios. So we do it on the long-term play, focused on safety and security. And, that our model allows our investment partners to own real estate, to get all the benefits that go along with owning real estate, while our company does all the work involved with real estate. So, don't let anybody fool you. If you're looking to invest in real estate, if you're looking to be an active investor, whether you're going to do wholesaling or rehabbing or the long-term plays, there's work involved. I mean, there's definitely work. There's a lot of ins and outs as far as acquiring the properties, as far as managing the renovation, the placing the residents, or, working towards a sale. If you're going to flip it, if you're going to retail it, there's a lot of moving pieces. So, I hear, over the years, I've heard countless speakers, at different events where they're pitching a course, they're selling a product, or, there's the podcast or whatever that say, do this in your underwear from home. Well, good luck with that. So, if you were looking to be a passive investor, which means you're the investment partner, you're the money guy. I mean, there's passive opportunities out there in real estate, but if you're on the active side, and in a later episode, we're going to dive into the difference between active investors and passive investors. But if you're an active investor, it's a job, it's a business. I mean, sure, you build up the portfolio, you build up the cash flow, you build up the residuals. If you're looking at the long-term play, it's looked at as a passive investment, but somebody still has to manage the portfolio and, has to take the calls from the residents, has to fill the properties, has to do all the accounting, the bookkeeping, everything that is associated with owning investment real estate. So I know I bounced around a lot of different points, but in this episode, just want to dive into the details of, or not the details, the high level overview of the three different types of investment real estate. And just to wrap it up one more time, that's wholesaling, retailing, and long-term plays. And that's it. We're just, like I said, in these episodes, in these podcasts, we're going to keep it brief. I just want to get you guys some content, provide some value here. And, we're just going to wrap it up. We're going to move on to the next episode, the next topic. So that's it. Thank you for tuning in. Have a great day.